So I just crossed the border and I'm in Malaysia right now. But if you're a Singaporean, you probably have this like magic number in your head when you cross the causeway. For a long time, that number was 3.5. But if you've checked the rates recently, I guess you're in for a reality check. Because right now, right, when you are in JB or Malaysia, the Singapore Ringgit number is closer to 1:3, right? So 1 Singapore dollar is now 3 ringgit, or 3.1 exactly. So how have Singaporeans now gotten used to a ringgit that has seemingly only seemed to go in one direction recently? So to understand this, we first need to understand a term called arbitrage. Like as Singaporeans, right, I think we're all guilty of crossing the border to make use of our stronger dollar to buy cheaper goods and services, some even pumping petrol here. But as of early 2026, the Malaysian ringgit hasn't just recovered against the dollar. It's at the point, right, it's almost borderline flipping it. Like, I'm not saying that the ringgit will overtake the dollar, but it's been such a reversal that a lot of things are changing. Over the last year, the ringgit has actually surged more than 9% against the greenback US dollar and is now trading, like I said, 3.1 against our Singapore dollar. And in Asia, right, if you compare it to the rest of Asia, it's already the best performing currency. So now we have to ask ourselves, right, is Malaysia's sudden strength a result of genuine economic success, or are we just watching a temporary correction? Is it a correction or is it a reversal? Because for the longest time, right, you could always count on Malaysia to fuck up its governance, corruption, or have some form of politics to keep the ringgit weak. For years, right, it was known as like the cheaper neighbor. If you look through its history, right, from the 1MDB scandal, the oil pricing collapse, and investors often viewing Malaysia as high risk because of their governance, there's a lot of things changing, you know? And early 2024, we actually saw all of these investors fleeing the ringgit and it resulting in a 26-year low in terms of the ringgit strength. But right now, as we are in 2026, this whole trend has shifted, right? So what's pushing this move? Basic economics will tell you that currency strength is driven often by monetary policy and interest rate differentials. So as the US Fed has been cutting rates, Malaysia's Bank Negara has actually held steady at 2.75%. So they are keeping their rates high while the US has been cutting rates all the way to the neutral rate, Fed funds rate, which is about going to 2 to 3% in the US. This means like what happened in Japan, investors or speculators can borrow in the cheap dollar to invest or collect yield in Malaysian assets. So how does this affect, I guess, you and me? Well, the next time you're traveling to Malaysia like me, you know, you're in JB or KL, if you're a Singaporean, I expect this trend to continue. I actually think we might get close to 1:3. And I think we are going to reverse that because that's a very magical number. It's like how Fibonacci is like a golden ratio. Once the Singapore ringgit is at 1:3, I think we're going to see a bit of a reversal play. Also, if you're one of those who like followed Tan Kin Lian, yes, the same Tan Kin Lian that tried to run for president and have been investing in Malaysian property, like if you actually follow him and, you know, invested in Johor Bahru property, this is probably paying off, especially with the new RTS Singapore JB line and the ETS from JB to Kuala Lumpur. So the big question is this solely because of the US dollar devaluation that we're seeing this trend? Or is there something bigger going on here? Malaysia has actually quietly positioned itself as the regional hub for data centers and AI over the years. And it's even overtaken Singapore as a tourist destination. Aside from that, they've also managed to lower their deficit to 3.5% and are actually sticking to their fiscal promises this time. So what exactly is a deficit? For those who are not financially savvy, it actually means that the government is starting to earn more than they spend, which is generally good because they have a bigger budget surplus. As always, if you want to learn more about financial markets or economics, do check out our website in the link in bio for our free newsletters and academic courses. Don't forget to like, share and subscribe, and I'll see you guys next time. Bye!